countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Thursday the 19th, 30 minutes to the close. What do you need to know out of Europe this hour? Well, European stocks stabilizing a little bit. They fell sharply earlier on. US markets absolutely flat. Luxury, retail, commodity stocks all being hit hard. The reason, Fed fears, growth concerns, Delta, Chinese wealth redistribution, all of that earlier on hitting investor sentiment. But as I say, bit of stabilization now. Goldman Sachs agreeing to buy Dutch insurer NN's asset management division. The price, 1.6 billion euros. It's David Solomon's biggest deal since taking over as CEO back in 2018. Gives them a big footprint here in Europe as well, a bigger footprint here in Europe. And a large UK study shows vaccinated people can carry as much virus as the vaccinated, as calling into question the idea of herd immunity. Basically, we're all carrying the same sort of levels. What does that mean in terms of the way forward? What does that mean for travel as well? This is what markets are looking like right now. The stock 600 down 1.5%. It's off its earlier lows. But the US markets are absolutely flat. In terms of the commodity story, I'm going to show you Brent, but other commodities have been under pressure as well. Gold, not so much. We're looking at Brent, Alex, down by 3.34%.
Yeah, and just to pivot off of that, look at iron ore here on my board, over 2% down as well. So all the commodity complex continues to get hit pretty hard. That's truly a stronger dollar story. They're jumping to the highs this session here, still a 9-month high, up by 0.5%. I have to wonder if part of what we're seeing here is back to that U.S. exceptionalism kind of story. We've had some form of buy the dip for a few days now. If it was all a taper tantrum, you would think the bond market would be falling out of bed. Rates would be higher. S&P would be plunging. None of that is happening. Rates very stable right now. S&P pretty much flat. There's a rotation to the safety guys, though, like utilities and real estate, for example. Clearly a safety trade happening in the FX market with the dollar as well as the yen and the Swissy. And also you're seeing the growth guys, the big tech companies, come back as well. Amazon up by 0.5%. Amazon's lost billions in market cap, below its 200-day moving average, but now we're seeing that stabilization as those growth companies now get more interesting. You go for the growth when you're kind of worried about other stuff. So I wonder if we're back to that exceptionalism theme here in the U.S., Guy.
Yeah, what's driving these markets, I think, is something we really need to think about. And what role are technicals playing in what we're seeing? Or is this just fundamentals, kind of what is happening with Delta, the concern around China driving all of this? The dollar index, the Bloomberg dollar index, taking another leg higher as we speak. 1156, spot 83 is where we're now trading. Joining us now to give us a technical look at where we are, because there's some key levels around, David Sneddon, Credit Suisse's head of technical analysis. David, always a pleasure to speak with you. Let's dive into the dollar first of all, because in some ways it seems to be at the center of what we're seeing, as I say, within the last few minutes. Another leg higher.
Yeah, hi, good afternoon, Guy. I think what you said up front is right there. I think there is a confluence of factors that are going on here in terms of growth concerns, taper, Delta, China's sort of concerns, and those are all coming together. And I think the FX markets and the dollar is probably now the key focus in terms of how this risk-off is expressed. Just purely looking at the technicals of the dollar, I think we would say first and foremost, the dollar has been in a sideways range all year, and that's been the story for the dollar. But we're clearly pressurizing the top end of that range. And what I would say technically as well is those lows that we posted this year are essentially these major support levels that stretch back to the 2018 lows, as we can see on the left-hand side of that chart. So we are holding in the dollar from some really long-term levels here. And that recent pullback that we saw, again, held some pretty good levels within this range around its 55-day and its 200-day average. And we're clearly now trying to break higher from the range. Now, we haven't quite done it yet, but it looks very close to doing it. And I think if we can get above this 1156 March high, that would establish a classic technical double bottom base for the dollar. And I think it would open the door to a more meaningful rise in the dollar over the next month or so.
Okay, so let's pretend that does happen, David. What's the downside then for the euro? We're not that far away from the lows that we saw back in September and November of last year.
Yeah, I mean, I think it's interesting. Up to now, you can argue the dollar's been in a range, but and you haven't seen, say, the euro break out of its range, you have seen some dollar crosses move. If you look at the Australian dollar, for example, that's been falling very aggressively already since May. And so the question now is, are we seeing the euro starting to put in a major top as well? I think the dynamic for the euro as well is it's not just a dollar story here. If you look at the euro in trade-weighted terms, that has been trending lower now for quite some time and taking out support levels. But independently, outright for euro dollar, the 117.03, 116.95 level that we're now pushing below and have been essentially most of the morning is a really critical inflection point for us technically. This is not just the low for the year from March, it's the first Fibonacci retracement of the entire 2021 uptrend in euro dollar. This breaks, we get a close below here. In our view, that would establish a major classic technical head and shoulders top for euro dollar. And we think that opens the downside not just to 116, but down to 115, 114.95, which would be essentially the big point of breakout in euro dollar from March last year.
Okay. I'm going to watch out for that one now. I've got European markets down, equity markets down. I've got Asian equity markets down. I've got US equity markets up in the form of the S&P, David. 44 even is where the number is right now, 44 spot 55. Talk me through what you're seeing when it comes to the S&P. It's been an incredible run. What does the technical setup look like right now? If we're going to see a pullback, where does it need to go?
So it has been, as you said, an incredible run. I mean, in terms of the developed equity performance this year, the US has been one of the key drivers of it. We've seen the US outperform for much of the year. And I think simply for the S&P, it's just bowing to the risk-off stories we're seeing elsewhere. You know, we've seen these signals come through in the emerging market equities for quite a while. In China, we've seen the strength in the dollar and weakness in commodities. And I think this is finally just putting a bit of a break on the S&P after a very, very good run. We actually saw the S&P hit some of our kind of big Q3 targets around 44.30, 44.50 a week or two ago. We saw a classic loss of momentum into those highs. And I think the S&P is just overdue a pullback and a correction. I think if we look at the background technicals, the breadth, the volume, positioning, sentiment, it's all fine. So we think this is probably an overdue correction in a healthy uptrend. I think where you look to think where does the big support levels come in, I think if you had on the chart you just showed, the medium-term average for the S&P, which is its 63-day average, which is the one we follow, that has pretty much held every setback that we've seen this year. That comes in around 43.25, 43.15 at the moment. So I think there's a risk we could still see the S&P down towards those levels. But at the moment, our view is we'd see no reason not to look for that to hold. And even if we don't see the market instantly make new highs, we think, you know, a consolidation would be followed by new highs in due course. So yeah, we're viewing this as a healthy and overdue phase, and as we see corrective pressures and risk-off pressures emerge elsewhere.
All right, David, thanks a lot. We really appreciate it. David Sneddon, Credit Suisse Head of Technical Analysis. Thanks very much. Let's get more insight here. Graham Secker, Morgan Stanley Chief European Equity Strategist, joins us now. Graham, you have European equities still low, off the lows, but still getting beat up. U.S. equities finding stability. You buying the dip in Europe?
Yes, ultimately we are. I think this is a combination of a few things, a little bit of a growth scare, coupled with some low volumes as we get towards the end of summer. And this could last for a couple more weeks, I suspect, but ultimately as we go through into September, investors come back to their desks. I think people are going to look out over the course of the next 6-12 months, look into 2022 and see still quite a positive backdrop. So I think this is effectively, should we call it short-term noise, but I'd argue that the medium-term fundamentals still look quite good.
One of the risks we are now starting to see highlighted, Graham, in a fairly meaningful way is the sort of the China relationship with Europe. It's manifesting itself at the moment very much in the luxury stocks. Is that connection and the uncertainty surrounding what China is doing at the moment going to put a little bit of a brake on forward momentum for European stocks?
I think in the short term, that's what's beginning to happen. And it's only really played out in the course of the last couple of weeks. We actually made an observation in a report 2 weeks ago, highlighting that European companies with high China exposure were still performing very strongly, even though the China equity index itself had had a very tough time over the prior 6 months. All of a sudden, this divergence has started to close. If you look at performance in Europe over the last 1 to 2 weeks, the sectors doing the worst have been those with that China exposure. And Europe does have a bit more sort of top line exposure to China than some of the other equity indices around the world. So we calculate around about 10% of European revenues come from China. And I think there was two phases to this. Phase one was some concerns around a bit of a regulatory clampdown. And at that point, because the market wasn't overly concerned about the growth consequences, these European stocks with China exposure continued to move forward. I think over the course of the last couple of weeks, what has changed is people are beginning to expect something of a more of a growth slowdown. And that's what we're seeing. And some of these sectors have been very, very popular places for European investors to put their money.
If the dollar does wind up breaking out, as we heard David talk about in terms of technical analysis, what kind of tailwind is that going to provide for European equities?
Yeah, it's quite helpful. Europe's a very international index, so a lot of its revenues and earnings come from overseas. So it's interesting, yeah. It wasn't that long ago, earlier on in the year, when we were worried about the impact of a stronger euro weighing down on European earnings. Now it's moving the other way. I actually think that's quite healthy. We've seen a very strong earnings recovery in Europe. European earnings will probably grow at something like 50% this year. And this move towards a weaker euro, which is also reflecting, by the way, the ECB's changing strategy, if you like, going back to July. So again, we're facing very, very low interest rates for a long period of time, which makes equity valuations more sustainable. At the same time, lights gone off here, as the weaker euro also provides not a massive support to earnings, but a decent boost.
We can still see you. Graham, final question. Why is the UK still underperforming?
Look, I think this is ultimately, a lot of this is down to sector composition. We regularly get asked whether or not this is Brexit related. We don't really think it is. The reality is that the UK index, particularly the FTSE, has very low sector exposure to cyclicals and technology shares. And they're the segments of the market that over the course of the last few years, global investors have wanted to own. So Europe's got one of the lowest exposures to technology. Sorry, the UK has got one of the lowest exposures to technology of any major global stock market around the world. The flip side of that is we have quite a lot of commodities and financials. We also have quite a lot of defensives, and both of those two cohorts are about 40% of the market. So you have 40%, let's call it cyclical value, and you have 40% that's defensive. So basically, they're counteracting each other out, and therefore the headline index struggles to go up an awful lot, and hence the UK underperforms a rising global index.
Graham, really great to see you. Thanks very much indeed for joining us. We greatly appreciate it. Graham Secker, Morgan Stanley Chief European Equity Strategist. We're going to dig into one of the segments that Graham was talking about in a little bit more detail next. Luxury stocks very much under pressure amid concerns about a crackdown on wealth in China. Redistribution is the new theme. We'll get more on that next. This is Bloomberg. One of the reasons why we've seen such performance amongst European equities this year has been the drive that luxury stocks have given the markets, in particular the CAC 40, but broadly the Stock 600. A big feature of the landscape has been names like LVMH, Kering, Richemont, doing incredibly well. You can see that on this chart. Blue's Kering, orange's Richemont, white LVMH. The CAC 40 you can see there as well. But these stocks have been real powerhouses until recently. You can see the drop that is being driven, it appears, by basically a new policy of redistribution that the Chinese authorities are keen to push forward with. They're keen to drive the middle class to the center of attention. What does that mean? Does it mean fewer LVMH handbags? Does it mean lower sales? China, super important for these companies. Luca Solca, Bernstein's senior research analyst for global luxury goods, joining us now to give us his perspective on this. Luca, as I say, the run for these stocks has been absolutely stellar, but China is now starting to rain on this run, and I'm wondering whether or not this is going to be a short-term phenomenon, as we've seen in the past in China, or whether this is going to be something more sustained that is going to be meaningful for these businesses.
I think you're absolutely right. The recovery out of COVID-19 has been very strong. We saw that in the second half of last year. And in the first half of this year, we had exceptional results in the first half of 21, not only in terms of top-line growth, but most importantly, in terms of operating margins being hundreds of basis points above the first half 19 levels. I think that the current reaction in the luxury goods sector is very much predicated on statements that have come from the Chinese leadership that can be understood in several ways. President Xi Jinping has been talking about the third redistribution of wealth, seemingly encouraging rich Chinese billionaires to donate more in a similar vein to what we're seeing in the US. And today, in the business newspapers in China, there was a notion of beefing up the middle class and experimenting in some geographic areas with inheritance tax and property tax. All in all, the Chinese repatriation of luxury goods spenders worked very well and has brought a huge amount of tax receipts back to the mainland. So I don't know that the Chinese authorities would necessarily want to jeopardize all that and potentially dampen Chinese discretionary spend as they are trying to build their economy on more consumption and less capital expenditure.
Luca, I guess the difference with that in the U.S. is that the U.S. can want it to happen, but China can actually force the redistribution of wealth. Does that give luxury?
That is totally correct.
Does that give luxury? I guess which luxury players could that actually give more consumers to?
You know, when we look at the luxury goods companies and their exposure to China, we find companies like Richemont, for example, or Swatch Group with high exposure to Chinese consumers, different price levels. If the new tax regime, which again is just being discussed and potentially experimented in some areas, is only going to address the very top end of the consumer population, then this would be relevant only for some product segments, like, for example, high-end jewelry or high-end watches. It's still very much to be seen. My impression is that the market, in a way, was keen to find an excuse to take some money off the table. Most of the luxury goods share prices were at an all-time high just less than a week ago. There's the statement, and the market seems to be thinking, should first ask questions later. We'll see how things develop and pan out as we move on.
Look, okay, so money's being taken off the table. Quite a significant amount of money's being taken off the table. Is that an opportunity? Are we getting to levels where you would be comfortable stepping back in?
My impression is that if we continue to find very strong support, as we've seen in the second quarter, in terms of all of the major nationalities buying luxury goods products, the Americans we saw were rebounding very strongly. The Chinese had continued to buy luxury goods products. The Europeans were stepping in and following the same path. We could find, as we saw today from Tapestry, we could find at the end of the third quarter another set very strong updates, and quite a significant amount of the concerns we're seeing today could potentially be dispelled.
All right, Luca, thank you.
Yes, we are constructive on the sector.
All right, Luca, thank you very much. We appreciate Luca Solca, Bernstein Senior Research Analyst for Global Luxury Goods. Okay, coming up, it is the biggest deal under CEO David Solomon. Goldman Sachs buying a Dutch insurance group for $1.9 billion. We'll break down the why behind it next. This is Bloomberg.
So Goldman Sachs expanding its presence in Europe. The Wall Street firm just bought the asset management arm of the Dutch insurer NN Group. They get a good price? Joining us now, Bloomberg's Tom Metcalf. Tom, others were interested. This is David Solomon's biggest deal since he took over in 2018. Did he have to pay up for the asset, and what does it bring him?
It's definitely clear Goldman really wanted this. So we're hearing sort of other people kind of got outbid by the Wall Street firm. And, you know, for him, it's the biggest deal since he became CEO, and it ticks a lot of the boxes. They're very big on ESG. It's obviously expanded into asset management. And then also Goldman and Europe, now in a post-Brexit world, it's a sort of another outpost for them in this time in Amsterdam.
Hey, Tom, who were some of the, do you have an idea of who some of the bidders were and sort of what else is out there?
Yeah, so probably one of the biggest ones was DWS, sort of a German company. You also had the Italian insurer Generali, I think, in the mix. And this is just kind of reflective of the whole industry. There is an absolutely, big appetite for consolidation. It's all a scale play. So it's no surprise Goldman is trying to get ahead of it, and clearly Solomon's targeting this as a growth area.
In terms of why Europe? What is going on here in terms of the need for Goldman Sachs to have a bigger footprint? We're certainly seeing very low rates starting to encourage more and more people to shift out of just simply having money in bank accounts to actually putting them into asset management. Are we starting to see Europe actually becoming a market that everybody's much more interested in?
Well, yeah, I think there is more interest. There's still, still hugely wealthy, obviously, and there's still plenty of money. So in the asset management space, that's where you kind of want to be. For Goldman, they used to be able to operate basically exclusively out of London. So now to getting feet on the ground is kind of valuable. And, from their point of view, the ESG kind of play probably makes it even more attractive.
How can the big guys in the U.S. compete more effectively with the European players? In that, do they come with less baggage in some ways? Do they come with more money? Do they come with more ways to, keep employees?
Well, I think in this case, they probably came with more money. And then it's just kind of all these banks are trying to be as global as they can. So if Goldman decides, hey, we really need to get into Europe, they can certainly make it a pretty compelling pitch to sellers.
All right, Tom, appreciate it very much. Thank you. Bloomberg's Tom Metcalf joining us there. I want to just break some news on Facebook. That stock now turning slightly negative on the day. The Facebook antitrust case is refiled by the U.S. FTC. The overhang for these big tech companies like a Facebook and an Amazon not going anywhere anytime soon. The question is, how much of a drag could it actually be for its business? But right now we know the antitrust case is refiled by the U.S. FTC. Facebook is now down by about 0.2%. All right, coming up, you got copper, iron ore sinking on growth fears and China's push to reduce steel output. We're going to get more on that with Ollie Hansen, Saxo Bank head of commodity strategy. And Guy, this very much weighing on European markets, despite the fact that you have U.S. equities now, the Nasdaq now flipping positive, up 0.5%, the S&P up by 0.1%. You do have that stronger dollar to the highs of the session, all weighing on that commodity price, which is also another reason why you're seeing the underperformance over in Europe versus the strength in the U.S. I also have to wonder if there's some U.S. exceptionalism happening in there as we head into the European close.
So a sea of red across Europe. It's been like that really since the get-go. We have seen a little bit of stabilization. The Asian session was pretty grim. We really picked up the baton here in Europe. All kinds of fears really coming to the fore. You've had what is obviously a significant story developing in China, the redistribution narrative, knocking the luxury stocks. We've talked about that with Luca Solca. You've got the Fed fears. That's certainly something that the broader markets are worried about. US markets seem to be taking it remarkably well. And then you've obviously got what is happening in terms of the Delta variant. All of this kind of coming together to produce a very negative Asian session, a very negative European session. Europe hasn't really climbed back. Some of the numbers are still really quite bad. The CAC 40 in particular under really quite a lot of pressure. So let's take a look at the broader picture. Let me show you what's happening with the Stock 600 over the last 5 days. And as you can see, sideways, 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 going nowhere, kind of August consolidation, and then this kind of big drop that we've seen this morning. We have, as I say, climbed off the lows, but we're still down. Over the last 5 days, we're down by 1.64%. Obviously, that comes in the last 24 hours. Let's take a look at some of the factors that are behind this. As I mentioned, we are seeing the commodity story creeping in to the narrative here. Brent's down by 3.5%. Copper's down by 1.87%. What is interesting is that gold has not dropped that much today. Normally, you would, if we are seeing a mass sell-off and everybody's kind of heading for the hills into the short end of the curve, you may see gold joining in on that. You haven't seen that. The other thing that's worth mentioning as well is volumes have been up a little bit today, but it hasn't been this kind of crushing wave of volume sweeping over the market on the downside. It is August, that is worth bearing in mind, but it's also worth thinking about the fact that that volume hasn't necessarily been there. Let's take a look at the individual markets. As I say, a little bit of dispersion today in terms of the breakdown. The FTSE, the DAX and the CAC are all lower. FTSE's down by 1.5. Commodities certainly a factor there. The DAX is down. Some of the car stocks are under a little bit of pressure. The CAC Iran, though, is down by 2.5%, 2.4%. The luxury sector is really where we are seeing the damage being done for the CAC Iran. It's been a huge driver of the CAC Iran. Remember, it's been one of the real outperformers in terms of the European bourses. In terms of the sector breakdown, it is a fairly straightforward narrative. We're seeing the same sort of narrative developing over in the United States. The defensives are at the forefront. Utilities, the only sector to be in positive territory today, up by 0.7%. Down at the bottom end of the market, basic resources, those are the miners, down by 4.18. Retail, then you've got the consumer products, which is basically the luxury sector. Energy's down there as well. The car sector's down too. I kind of walked you through it. That is what we're seeing. You can see it kind of differentiated in the different markets. But as I say, luxury certainly feeling the pain. There's been a few kind of non-related stories today, which are worth focusing on. NN Group, we were just talking about that with Tom Metcalf, Goldman Sachs buying its asset management arm, but that stock's still down by 1%. LVMH, there it is. Others are doing worse today, but LVMH is down by 5.8%. Anglo-American, yeah, we're coming through the end of the reporting season, and as a result of which you need to bear that in mind in terms of payouts. But Anglo-American is down by 9.98% today. The rest of the mining sector is under, Alex, significant pressure today as we see iron ore, copper, all of these kinds of metals really seeing significant downside.
Yeah, you name it, it's down. So iron ore was hit particularly hard as well. China's effort is really trying to curb steel output. So is it about the dollar? Is it about China? Is it about Delta? What is it? Joining us now is Ali Hansen, Saxo Bank Head of Commodity Strategy. What is it? Is it the stronger dollar? Is it real demand problems, or is it just Delta fears?
Well, good evening. I think this latest worries really kicked off when we started to see the Delta making a return or making its presence in China. So it is China-centric. It is the China-centric commodities that are suffering. That's taking the brunt of this sell-off. Iron ore leading by the front to the downside. And at the same time, we also seen this attempt today after the taper message yesterday that the dollar is trying to break higher. It hasn't really succeeded, but that really was enough, I think, to keep just get the ball rolling. And some of these markets have really been holding up quite well for quite a significant time, especially copper down 10% after doubling price. Now we're seeing some long liquidation there as well. So I think these are primarily short-term impacts. The steel story is one that will impact iron ore, of which there's plenty of supply, but one market where the supply potentially could be start to become more tight over the coming months, that will be copper due to that green transformation. So seeing this as a correction, speculators have been on a long side. They're potentially just deflating a little bit of that exposure right now. So it's a question of being patient, I think.
Okay, where would you get back in, Ollie? We're trying to figure out where the floor is for some of these metals.
Well, if you look at copper, which is probably still one of the very popular trades, we broke below 9,300, various trend lines emerging in that area. When that was taken out, the technical sellers emerged. If you look at the chart now, the 38.2% retracement of the whole rally we had from the lows last year comes in around 8,300. So I would call that a major line in the sand. Iron ore is still trading well above the average for the past 5 years. If we are seeing a slowdown in demand from China, and we are seeing ample supplies both from Australia and from South America, then that potentially has further to go to the downside.
Ali, we say a lot in the markets, right? Don't fight the Fed. And in commodities case, it's sort of like don't fight China. If they want less steel production for emission reasons, that's going to mean less iron ore demand. Do you have a sense of sort of what the price is going to wind up being medium term for iron ore if we have these kind of pushbacks from Beijing?
Well, in that case, closer down towards the $100 level. But what we also have to remember, a day like today where we drop more than 10%, quite a lot is also capitulation. So there will probably be some bottom fishers starting to emerge over the coming days. So it will not be a straight line. But if that is the future we're moving into, then the upside potential most certainly looks limited, and the risk of a move down towards, I'll say, down towards the 120 area potentially could be on the cards.
Those are some fairly big numbers in terms of the drop that we are likely to see. A few months ago, we were all talking about the notion of a super cycle. Has what we have seen over the last few days undermined that case? Or, as you say, is the Greens transition, particularly for metals like copper, still making that the most viable and likely outcome?
Well, the green transformation was getting increasingly expensive over the past couple of quarters. Now it's slightly less expensive, but I think the green transformation theme has not gone away. I think the summer we've been through across the world has probably just strengthened the political will to move forward, and that basically means demand for for many of these green metals will continue to remain robust. So I think on that basis, even though we may see a somewhat weakening in China, then the rest of the world will pick up the slack. And at the same time, also we're seeing some of the weakness in China potentially also being met by new initiatives over the coming months. So China-centric commodities, iron ore at risk. Some of the others are probably less so.
I do want to get your take on what's happening with the oil market, because in some ways that feels a little more idiosyncratic. Sure, it can still get hit by $1. It's still a delta and demand story, but it's so actively managed in some ways by OPEC+. What do you think the result is there after the slide that we've seen in terms of more production coming?
I think we're just basically sitting here waiting for the verbal intervention to return. OPEC Plus done a sterling job in supporting the price to bring it back to levels which are acceptable for everyone. Now that's suddenly at risk, and I think given the fact that we've seen previous spikes in coronavirus outbreaks, they've had a 2 to 3 months impact on the price action. So starting to not coming in sooner or later to support the price, given the potential short-term impact, instead of risking that we're getting a technical setup, which basically means that we're going to get more speculative reductions in longs. I think they want to avoid that. So I'm waiting for headlines to emerge fairly soon. So we've been calling for 65, 75 wide range, I know, for Brent for the remainder of the year, and we're getting pretty close to the low end of that. So if that's going to hold out, we need to see some support fairly soon.
Just very briefly, dollar up, gold not down by very much. Are you surprised that gold is holding up today? Not in particular, because some of it is potentially a bit of safe haven, because when it's so nervous everywhere else. But I think the market's been quite surprised by the fact that we're actually seeing bonds trading up on a day where the market's talking about tapering, and they've been taking that as a good sign. And I think at the same time, there's been a lot of worries in the gold negative related to the dollar, and the fact that the dollar did break higher today, but not really seeing any acceleration in that dollar buying potentially also has added a little bit of comfort into the market. But by no means we're not out of the woods yet. We need to see it at least above 1830 before we can start to talk about a bottom in the market. Ollie, really great to get your take today. Thank you so much for spending a bit of time with us. Ollie Hansen of Saxo Bank. We do have a fairly major commodity event coming up later on in the form of Commodities Edge. I feel it would be sort of remiss of me not to speak about that.
I do appreciate the
I appreciate that you're going to be leaving the cable a little earlier than normal to do that show. So I obviously feel a little bit aggrieved on that front. But Commodities Edge is coming up. Today of all days is a perfect day for everybody out there to watch Commodities Edge. Every day is a perfect day, but today in particular is a perfect day.
It does feel a little bit, though, like catch a fallen knife right now in the commodity market. But yes, even if you're not a pointy hat commodity person, definitely watch at 1 p.m.
There you go. European stocks, I think we're done for the day. These are the final numbers. We have seen, obviously, a fairly negative hit being generated by those commodity stocks. Anglo did go, as I mentioned earlier, XD today, which is a factor, but the commodity stocks generally have been under pressure. Luxury stocks have been down as well pretty hard, Alex. That's why the CAC Euros underperforming in the way that you can see that it has been.
Yep. All right, coming up, let's get back to the Delta variant here. UK reaching a 5-month high in COVID hospitalizations. We're going to break down the new study out of the UK that says vaccines may not be as effective as we think. We're going to have more on that latest next. This is Bloomberg.
The first word position. This is Bloomberg Markets, the European close. I'm Laura Wright. You're looking at a live shot of the principal room. Coming up, City of Miami Mayor Francis Suarez at 1:30 p.m. in New York. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Laura Wright. President Biden says the Taliban are in the midst of an existential crisis about their role on the international stage. But he told ABC News he doesn't think the group has fundamentally changed. The president's comments point to a looming question of whether the U.S. will recognize the Taliban as Afghanistan's government. Goldman Sachs is expanding its presence in Europe. The firm has agreed to buy the asset management arm of Dutch insurer NN Group for about $1.9 billion. About 3/4 of the business's $355 billion in assets are backed by environmental, social, and government criteria. A new study says that coronavirus vaccines are less effective against the Delta variant of the disease. That could lead to a push for booster shots for fully vaccinated people. The British study said that Pfizer and BioNTech's vaccine lost effectiveness in the first 90 days after full vaccination. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
So I want to come back to that study that Laura was just talking about and also deal with the data that we're seeing out of the UK. The UK reporting 113 more COVID deaths today. Hospitalizations, they're the highest we've seen in 5 months. Let's talk about all of this. Oksana Pizik, UCL School of Pharmacy and Global Health Advisor, joining us now on the line. Oksana, I want to start first of all with that study that we've seen coming out of Oxford. There's a number of different strands that are worth focusing on, I think. But the one that I really kind of want to focus on is the idea that even if you are vaccinated, you are still carrying, potentially carrying a significant amount of virus, and as a result of which, the whole idea of herd mentality, herd immunity might go out of the window.
Well, there's a lot of herd mentality going around COVID discussions, but that's a separate issue. What I would like to highlight here is that while it is disappointing in terms of the level of effectiveness around transmission, the vaccines are still doing what they are meant to do. So our measure of what success looks like should also adapt towards that, because they are still very effective, even in light of Delta, of preventing serious illness and hospitalization. And that's the goal, particularly as it's looking increasingly likely that this is going to be an endemic disease. So transmission, we won't be able to stamp that out going forward, but there are ways to protect the population, and this is why vaccine coverage and making sure people get those 2 jabs of vaccine, not just in our G7, but around the whole world, is so important.
Right, Oksana, for sure. And I wonder, though, as we go towards the booster world in developed markets, what do we prefer? Do we want the mRNA, which looks like it's more effective up front, but then can lose efficacy fairly quickly, even though we're still over that 50%, or the traditional vaccines that kind of stay steady in terms of their effectiveness?
Well, I think we're going to need a blend, and we're going to need mRNA vaccines also have the advantage of being able to scale up production faster than the traditional method for the AstraZeneca vaccine. But there's also the price to consider as well. In many low-income countries, only 1.1% of their populations have been fully vaccinated. And this is the majority of the world, where high levels of population, very densely living in close quarters with high levels of community transmission, low vaccine coverage, and weak health system, it's just a recipe for a new variant of concern to emerge. So I think, as long as we can get a blend of those vaccines that suit that context out there as soon as possible, and I think Biden administration have done the right thing to back the TRIPS waiver on this for IP restrictions, then we're looking at the best long-term view. So I don't think we need to nitpick to that degree. A jab that we can get as many people's possible coverage should be the priority, not which brand.
Okay, but the brand issue is important to a certain extent, though, isn't it? In as much as are we at the point now where it would be better to give those, for instance, that have had Astra an mRNA vaccine as their booster, and potentially vice versa? Do we need to start mixing the vaccines up?
Well, it is interesting to see that mixed vaccines have good efficacy, and that could be a strategy going forward that we already see other countries such as Germany, Canada doing that. But I would hesitate on the timing of these boosters. I think the data isn't there yet to justify within a 6-month period. It may be that boosters are needed down the line, but I think we need to get the many other countries vaccinated first, because we have a limited supply of vaccines. So we're redirecting supply from one part of the world that already has sufficient amount of protection. It's like giving an extra life jacket to someone who already has one when everyone else is doing well.
So I guess, Oksana, that sort of brings in the question of kids. You see developed nations like the UK and the US vaccinating children, 12 and up, 16 and up when it comes to the UK. Do we vaccinate children before?
Well, I think the UK has become an anomaly on this in terms of not vaccinating below 16. I think that because we know that there are also very little other interventions in place in schools, reventilation, and we've completely removed the mask mandate, it's important for us to look at layers of protection. In the U.S. and certain states, there are HEPA filters and air purifiers that have been put into schools, and the UK is ignoring all of that evidence. So I think that while, yes, we are still learning about the implications of long COVID, I don't think it's that with Delta we can say that it's completely harmless to children, which was the assumption very early on in the pandemic. So I think the UK JCVI have to relook at this evidence and shift towards what Canada, the US, and EU are doing with lowering the age for which people get kids get the vaccine. I think that's the right move forward, and I hope that we can simultaneously boost supply and scale up manufacturing.
Given all of that, and given the UK data we've seen today, you talk about us moving into an endemic environment where the disease becomes endemic. But what I took away from the transmission story that I read this morning was that social distancing is going to become much more normal. Is that something that is going to be something that we have to deal with in the long term, that social distancing, mask wearing, etc., is just going to become part and parcel of life?
Well, it's interesting. When we look at sort of the Pacific and Asian countries that had been hit hard by SARS earlier, so if we go back to 2003, we see many of those cultures during flu season is basic respiratory hygiene, boarding a plane, et cetera. They've really normalized that during certain seasons where it is riskier and there's more transmission. So we could be looking at something like that, but I think we'd all be talking about urban design and allowing spaces that have more advanced, like in hospitals, that level of air filtration. It's not just COVID. We could reduce the burden of disease for many viral infections, and that would be the benefits of that would compound far beyond COVID-19. So I think we need to be looking at this as a holistic issue, rather than just forever staying 8 feet apart from someone.
Such a good point, and that is a readjustment also for investors on how to deal with that. Oksana Pizik of UCL School of Pharmacy, thank you very much for joining us. This is Bloomberg. Live from New York, I'm Alex Steele with Guy Johnson over in London. This is European Close on Bloomberg Markets. All right, it's busy. It's still busy. Coming up next 24 hours. Actually, today you get the State Department press briefing in the U.S., so don't miss that. Plus the Bank of New Zealand rate decision and Tesla AI Day. I'm actually really interested in that Tesla one.
Absolutely, particularly given the recent regulatory concerns. Tomorrow, UK consumer confidence is going to be certainly something to watch out for. Is Delta having an impact? We get retail sales as well. And one of my favorites, earnings from Deere.
I love Deere too. Did you just say that because I like it?
No, I would never say that.
Sure, you would never do that. No, I genuinely love it too. The commodity angle, industrial angle, the whole thing. All right, well, that wraps up for Guy and I. Me. Coming up, Andy Slavid, President Biden's former top pandemic advisor, will be joining Balance of Power with David Weston on television and radio. Guy and I going to radio. This is Bloomberg.